Welcome back. Let's talk to Phillip Shaw. He's Chief Economist at Investec. Phillip, welcome to the show. The UK PLC, buy, sell or hold at this point in time?
In terms of the stock market?
Just the big picture from manufacturing sentiment, the British weather, the stock market, the Premier League. What are your thoughts?
Well, the weather's probably the easy one. I think in terms of the rest of it, I think I'd be a hold, and it's a relative hold, I think, against the rest of the global economy. I think if you're looking at GDP numbers, look, they've not been great. We know that the economy held up pretty well after the referendum last year, in the second half of the year, but what we've seen subsequently is a slowdown in the economy, largely, though not entirely, based on higher inflation, pay growth not keeping up, and therefore you've seen that slowdown in consumer spending growth. I think from here, you're probably looking at steady growth, perhaps a little bit firmer in the second half of this year, after a disappointing H1, and then gradually ticking up through the course of 2019, or 2018, then 2019. Brexit, big uncertainty over what the exact arrangements are going to be and how they're going to impact on the British economy. But there does seem to be some arrangement agreed, at least within the UK cabinet, that there should be a transition deal of up to 3 years to prevent the cliff edge. So that should stabilise business confidence. Now, what the UK's European partners will say in negotiations is a different matter entirely, but at least the UK government's objectives seem relatively sensible from this point.
Bank of America Merrill Lynch, I think, put out a report that they thought that everything was in place for a big autumn correction in the global stock markets. Obviously, if the US moves south, the UK would follow. Is there anything out there that's really worrying you at the moment, whether that's the bond markets, interest rates, inflation, a football team paying £200 million for a football player? Is there anything there that you think, wow, that's causing me concern?
Well, I'd look at it from two levels. Number one, if you look at valuations, stock markets aren't cheap, and I think we all know that. But our assessment is that they're not particularly expensive either, if you believe the global economy is holding up relatively well, which we do. If you think that there might be a correction, you have to consider what the trigger is going to be, because typically stock markets rallies don't die of old age. They normally have something sparking a sell-off. And what we've seen very encouragingly over the last year and a half is, quite a lot of cessation or abatement of those downside risks facing the global economy. So that reduces the number of potential triggers leading to that sell-off. Now, anything could happen from left field. I mean, we've talked about North Korea in the past and, what sort of a downside risk or at least uncertainty that could pose. Yeah, that's possible, but it's difficult to see, particularly with the Chinese economy stabilising as well, where that spark for a big sell-off is going to occur. So, I wouldn't necessarily say that stocks have got massive room for growth over the next 6 to 18 months, but perhaps a sell-off is less likely than it has been in the past. When we've come back from the summer a couple of years ago, for example, those sort of danger lights aren't flashing to us.
Albert Edwards this year, I think, was called the analyst of the year, and it just crossed my mind, being a little bit cynical in my old age, that he's been so bearish for forever. I was surprised he won that cup.
Well, I'm not going to comment on an individual analyst, but certainly if you look at some of the bears in the market, they provide a very valuable service by just cross-checking the bull's views.
Yep.
And just trying to identify those individual risks which might upset the apple cart.
But he's the only bear I know.
Well, I'm sure they are out there if you look hard. I mean, we're not particularly bullish, but we certainly wouldn't put ourselves into the bearish camp either.
Well, just a piece on technical analysis. I've been told all summer about this Hindenburg signal, which suggests a massive sort of technical analysis sell-off. And each time this signal's come up, it's basically been null and voids, but apparently it's all lining up for a substantial correction on the charts.
Well, that's quite possible. I'm not a technical analyst myself. My preference is to look at the fundamentals. But one piece of almost anecdotal market information you get is that there still is cash on the sidelines, waiting to invest in equity markets. So that's not to say you're not going to get these minor corrections on the way, but for the time being, investors seem to be happy to invest. Now, perhaps when the Fed starts to reverse its QE operations, that liquidity gets taken out in the market, you have a different set of market conditions. It remains to be seen. But that is something that we have flagged on the horizon as being at least potentially a negative force.
Philip Shaw, we run out of time. We don't see you enough here on the show. Fantastic stuff. I know I'm going to sleep better tonight. Phil, thank you very much.
My pleasure.